Hey, welcome back, everybody. And, well, you better enjoy your day today because I hear the rain is coming. So, anyway, later on this afternoon, evening, and then tomorrow. So, make sure you get out, do whatever you're going to do because, well, the rain is coming. Anyway, with that, we talk about rain and we talk about kind of bad news. And you're saying, George, what the heck, man? The Fed dropped rate. Mortgage rates actually kind of went up. They kind of bobbled a little bit. What the heck? I thought that the two were like conjoined. They were together. The Fed drops rate, mortgage rate should drop. Nay, nay. Let's go over that. All right. So remember, the Feds have nothing to do with mortgage rates. Mortgage rates are publicly traded. The Feds, however, they will control what your car loan interest rate's going to be, what your credit card interest rate's going to be, what your HELOC or home equity line of credit, what commercial lending is going to be. That is what the Feds control. Now, the Feds can affect mortgage rates, and in this circumstance, well, they actually, like last year, went up. I know, not exciting at all. But here's the good news. The good news is that even though they bobbled for a little bit, and up, down, up, they actually have been on kind of a downward trend. All right. Now I agree with that because here's the funny thing. Last year, whoop, it went way up. So as we take a look at kind of what the metrics are, what we're seeing when we talk about mortgage rates going a little bit higher, okay, we'll actually take a look at some, in fact, let's head over to the Freddy chart here, and you can see, so each one of those areas is where the Feds actually met and how did it affect mortgage rates. And you can see 3 times last year, especially this time last year, it went way up. In fact, it hit the 7s and whatnot. Then, this year, Feds met again. Yeah, bobbled around a little bit. But as you can see over here, so we were heading down, we dipped down, then we popped back up again, and now we're coming down. That's the upper right-hand picture there. And you can see where we went back up, and now we're actually heading back down. So with that, we also have a big jump in mortgage rates in mortgage applications, and that is situation normal, which actually also affected what we're going to look at, what we are going to see as we roll back and forth with what's going to happen with the next job employment numbers. What are we going to see with the different CPI? More importantly, the dot plot, which is what the Feds create, where each one of the Feds, where they figure rates are going to be and they project that forward. It's called the dot plot map. That actually comes out just before and will have a bigger impact on what the Feds will do or what bonds will do, which is what controls mortgage rates. Now, setting all that aside, at the end of the day, what'd that do with buyers? That's the really important question, right? So as we come back here and we take a look at what we see as far as our market, interestingly enough, when we take a look at that bottom chart, that's kind of interesting because we are seeing an increase in actual activity, but our days on market are still at 10 days. When we take a look at our chart here, we had 1,083 that came on market, 1,148 that went off market, meaning it went pended. Okay, so if we have 1,000 homes come on, we have 1,100 that are going off, that is a definite positive trend. Now, what's super important when we take a look at, when we talk about trending, we talk about what's coming on market, going off market, look at this. So for the first time in, I think, a year and a half, we're actually at 3 months of inventory. And that's a bigger deal. 3 or 4 to 6 months is considered a balanced market. Really, 2.5, 3 months, I think, is more of a balanced market. That's what it's been over the last 10 years. So as we're going through and we evaluate this each week, yes, we're seeing that inventory level increase. We're starting to see inventory levels start to get back to the norm. That's not necessarily a bad thing, but we do want to make sure that we don't get too aggressive there, because as we start rolling into, and again, if you want good information here, as we start rolling into our numbers, that's at the end of the day. If we blow those up, look, we're still almost 2% more pended sales today. That's the top chart there. And of course, that's based off of this right there, right? Okay. So we're still about 2% above. And in fact, for the month of September, these are up to the 19th. Look, you can tell we're almost 7% more on solds, which those are what happened in August, right? So we're looking at closings 30 days out. So we're always having a 30-day lag. So we're always looking in the rearview mirror. These are what closed or went under contract towards the end of August, which we did see that increase. Why? Because mortgage rates are coming down. So a dynamic number to absolutely keep in mind is the fact that our actives and our pended, those are very dynamic numbers. Sure, new on market that's just a metric that we monitor, but we can tell that we're almost 16% as far as actual pendeds year over year for the same month of September. That's a really good number. It's not a massive number, but it's still a really good number, and we're still trending in a positive direction. And how do we know that? Well, it's simple enough. Hey, when we take a look at the actual sales price, for the month of September, we're almost 3% higher, even though our our list price is down almost 1%, but we're still 1.1% higher average sales price than we were this time last year. Okay, so all things considered, we just kind of keep heading in a slightly upward sideways trend. Not unexpected. It's an election year. There's a lot of things happening out in the market. There's a lot of political things that are going on in our world that have an absolute impact, and including local, when we talk about our macroeconomics, we talk about some of the hiring, firing, and retention, that 3-year cycle. We're in the fire stage. Next year, they hire, then we retain for a year. It's the same thing every 3 years. 2023, when we started going through this, during that little brief period of time, same thing. It's what I would call a situation normal. There's nothing crazy going on, but just keep that in mind. So if we take a look at new construction is actually doing incredibly well. Yeah, they might be off in the center chart there. They might be off, 82 homes, right? But when we take a look at it, their percentage of homes that went pended and sold, those actually improved. Yes, they're still in the negative, but they actually improved. And down below, we can see that, hey, we had about a 71 home improvement as far as pended over this time last year. Again, that is absolutely really good. Why? Well, because we have been seeing consistently the new construction playing catch up, and they're actually doing quite well, and they're catching up. A lot of that is some of the incentives that they offer, and we can see that right here. List prices continue to head in an upward trend, about 4%. But look at that, our sold prices are up 19.9% so far for the month of September. That's actually quite good. Year to date, it's up 3%. So yes, we're still seeing some of those changes. And yes, we're still seeing a positive direction. And yes, month end, hands down, best time to buy new construction. Just saying, most flexibility. Make sure the agent that you're working with, don't go to the builder direct, okay? Make sure the agent that you're working with is very familiar with how to negotiate with builders. They're not going to negotiate price, but there's back end things that you can really benefit from. And whatnot, and especially with like some of the Lennar developments, there's a lot of upside there, just because of how they choose to or not work with agents, and there's a huge benefit there. Anyway, moving on. As we take a look at bank-owned homes, again, super boring again. Why? Because our inventory is super low. It's not exciting at all. The year to date, it says we're up 3%. And look at that. You'd say, oh my gosh, look, solds are up 30%. Pendeds are up 43%. Year to date, 72% for the month of September. Oh my gosh. Oh, that's only 13 homes. Why? That's not super exciting. Look, if you look at solds, you know what? They're actually up 100%. That again is not very exciting. Why? Simple enough. We're dealing with tiny, tiny, tiny little numbers. That's all. Okay. So when we deal with tiny, tiny little numbers, look, at the end of the day, we have one of the lowest foreclosure rates in the nation. We're still below, from what I'm understanding, below the 2% mark. And when you look at how much equity people have gained over the last, 2, 3, 4 years, most of them are able to have a workout. They can do a modification. They can do a 40-year mortgage. It's a lot of different opportunities out there. I'm not saying we're not seeing any foreclosures. I'm not saying that. I'm just saying there's not many. And the ones that do come back, those are actually being marketed at full price, have to do the basics. Paint, carpet, vinyl, get it on, full price. They're getting them sold. You just saw the metrics there. They get them sold. All right. If you have any questions, put them down below. Tell us what you think. And smash that subscribe button. Let me know that you like what you hear. Do us a solid. Let us know. Let everybody else know. There's no marketing here, so other people can enjoy these weekly metrics like you do. In the meantime, have an absolutely beautiful weekend. I will see you on the next video. Take care.